What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is August 11th of 2021. Well, folks, I hope you are having a fantastic day wherever you are, and in today's video, I want to spend some time to dive into what is being claimed to be the largest DeFi hack in the history of cryptocurrencies, with over $611 million worth of digital assets stolen by an anonymous hacker. Now, I want to go ahead and cover a few different things here. First off, talk about the good news that the money is looking like it'll be returned as time progresses. There's already been some funds sent back over from the exploiter's address. But outside of this as well, talk about why it's not a per se DeFi hack, but rather a interoperable layer 2 technology being hacked or exploited. And last but not least, no matter what is being hacked or compromised, we need to understand some ground rules in order to avoid having ourselves in a position where we're being exploited through one of these new emerging protocols, whether it be a DeFi protocol or layer 2 interoperable technology. Whatever fancy label you want to toss at it, let's go ahead and talk about some of those things as we go throughout the conversation. Now, this exploit is real, guys. You can see it on chain. It was an exploit across multiple different blockchains. However, it wasn't an issue of the core protocols, nor was it of any specified DeFi protocol. This was an issue with the way that a technology or a project known as Poly Network was communicating across multiple different components that allowed it to build a cross-chain or cross-bridge technology in order to interoperate between multiple protocols, such as Binance Smart Chain, Ethereum, BSC, a lot of different networks that were exploited in this case. Again, not the core protocols. There's not a problem with Ethereum. There's not a problem with BSC. It was how Poly Network was actually communicating access to these bridges where assets are being stored, right? Now, if you guys want to dive into the full read here, there's a really great tweet from Kevin Fitcher here. I'll go ahead again and link this in the description if you guys want to put in the comments. And you guys can find this if you follow him on Twitter. It's got a great read on an interpretation of how the exploiter was able to reach into the vulnerability of Poly Network. But again, I won't dive too much into the details of that because, to be completely fair, guys, I know a lot of people don't like to say this, I'm not 100% qualified. I'm not a Solidity developer, and I'm not a complete expert in the sense of understanding all of these different components for communication. But as all of this is important to take into mind, I want to go ahead and talk about the details and the things that you should keep in mind. Things that don't require you to be a Solidity engineer, the street smarts that you should know about when interacting within the cryptocurrency space, and some best practices to follow. So let's just go ahead and take this from a high-level overview. You know, DeFi as a whole right now, and again, people are calling this a DeFi hack, though this isn't per se a DeFi hack. Whether you're talking about layer 2 protocols where there's cross-chain activity and there's bridges, so there's new technologies that are allowing for that, or DeFi, you are easily talking about a near $100 billion asset class. In the next coming weeks and months, we're going to easily topple over $100 billion, and I bet there's some projects that aren't accounted for here, right? A growing number of assets, both on the actual basis of ETH and wrapped Bitcoin, as well as their dollar value, are going into a variety of these protocols. Protocols that are programmed to function a certain way. But outside of this as well, have a variety of other things that you need to be concerned about, such as admin keys. Along with that as well, not going through proper audits. There's all types of things that you should keep in mind when investing in these different protocols, or even just utilizing them. Even if you don't own the token or have an invested stake in it, having your money on these protocols can be even more risky if you don't do your due diligence. So the good news, though, I do want to share here today is that it looks like the hacker is starting to send money back. Though this is not something that always happens. What you tend to find is you get one of two situations. You either get a white hat hacker, someone who is willing to exploit the contract or point out to the team, hey, I want to bring this to your attention. There's an exploit. You need to fix this and redeploy it, right? And if they ignore that, then usually the white hat hacker will exploit it and return the funds. That's kind of the middle case scenario. And that seems like what we're getting now. But in a lot of cases, you have it where the person never returns the money and starts to kind of spread out the money and try to, in a sense, kind of obfuscate or make it go through some kind of privacy or anonymous channel where they can, again, start to actually hopefully realize some of their money, right? That's the goal for most of these hackers. And it seems like that was where the hacker was going, and luckily they decided to return that money, or at least they're starting to. We can see here on the actual Poly Network exploiter here within Polygon Scan, We can see that they're starting to return this fund. So go ahead and refresh it here. It seems like the last one they did was a million USD back, nowhere near the full range of the exploit. But you can see as well within these addresses, different types of transactions where people were leaving actual messages on chain where they were saying like, please, this is my life savings. There's a lot of different real messages that people started to send. It's an interesting way to see how people were starting to communicate this, or in some cases request funds. And you could go here and look at the UTF-8. So this person just was speaking, I think they're speaking a different language. I'll see if I can get one where they were speaking in English, but you can go down here, view the default, and it looks like someone's spamming it. So I don't know, maybe I'm doing something wrong. I'm pretty sure I got it right here. Let's see if we can get one. Right. Yeah. Hello, sir. Please send me anything. And, people were asking for, rudely enough, some people were asking for airdrops of other people's money, from the hacker exploited. But look, I digress. Like overall, you had a lot of people leaving remarks saying, please, like, this is my life savings. I had to invest this protocol, right? People who had gotten way too overexposed to it. And luckily, they're starting to return some of that money. We can see here on chain. So let's go ahead and talk about best practices here, how you can avoid being in one of these scenarios here, and where you don't have to be a genius to spot these different things. Well, it's basically you have positive signs, and then you also have so let me just go and get rid of that. So you have the positive signs here and the negative signs, and they kind of counteract one another. So basically, if you follow the positive signs, you'll know what to look for the negative signs, right? The first one here is making sure that the product or project that you're investing in or utilizing has conducted multiple audit contracts. Now, we do have a sponsor in today's video that I'll talk about later on that has actually gone through multiple routine audits and is, again, in line with what we want to look for, all right? So conducting multiple audit contracts. For those who don't know, an audit contract is where a project submits its code to some type of firm or organization that routinely goes through and looks for multiple different forms of attack vectors. They look for any types of line of code that aren't doing what they're intended to do. So maybe there's a rewrite or maybe a removal of that function, or maybe even a dramatic simplification where the contract won't be able to deliver on all the things it originally wanted to do. Right? Those are the kind of things that you discover during audit contracts. It's just like how someone might do an audit of financials, right? The second thing here is showcasing open testing on testnet. This is something that, honestly, again, I don't think there's any room for debate. And there's a bit of arrogance in some of the DeFi space on this topic about deploying straight and directly to mainnet. The idea of simply deploying something without audits, for that matter, and this is what you find so many times, people not going through audits, being so confident in their code, and then deploying something on mainnet, and then people go out and use it, and they go, oh, sorry, that was your fault, right? That was your fault for using that. No compensation. Sorry, someone exploited the contract and stole your funds. That's a terrible standard to me. But the unfortunate reality is that the person who deployed that contract and said it's your fault, unfortunately does have a decent point. As much as on a moral basis, it's wrong, in my opinion, and I think in the opinion of many other people. At the end of the day, if you submit your funds to a contract that has not gone through proper testing, through routine criticism, and through routine audits, you are at risk to potentially lose your funds. There might be a great yield farming opportunity that you need to use the Poly network for as a bridge to move from one chain to another, arbitrage opportunities. But if you don't focus on the core technology of the protocol, going through some routine checks and balances, or at least try to hedge your bets and use a variety of different technologies, then you are at much more risk to lose everything if you expose yourself too much. And the last thing here that I think is a really good kind of principle to follow, and it's actually something that, again, is subjective, and it's not 100% true and foolproof, but the greater the TVL, or total value locked up, and we saw that here back on DeFi Pulse, we can see that there are some protocols who have much more value locked up. Aave has over $15 billion of assets, Compound 10 billion, Curve Finance 10 billion, you get some in double-digit territory. As you have protocols that have a larger amount of value locked up over an extended period of time, and Aave, as you can see here, compared to a lot of the DeFi protocols you'll see on this list, has been around for a long period of time. And this is just since where DeFi Pulse was tracking assets, right? Aave previously, in previous versions, had been around for a lot longer, right? It was originally ETHLend, right? And you also have Compound, which had been around since back in late 2018, or at least that's when I had started to use it at that time, early 2019. So the greater the TVL and the length of the project it generally means it's more secure. Because if there is an exploit that is known on that contract, it will usually be exploited as the TVL gets to a great enough point or as more and more faces get to see the project. Right? So again, the general premises, and I'll try to reword it a little bit better, is that over time, there's more incentive to look for exploits with there being more total value locked up in the protocol. And also as the length of time increases, more people generally know about the protocol. So therefore, more white hat hackers, black hat hackers who are looking to, extract funds from the protocol, they will usually extract it as time progresses and as the TVL grows. Now, the negative side is pretty simple. I'm not going to waste too much time on it or ramble on too long because I think I've rambled on a decent amount. The negative signs are this: looking for projects that are first to market, are eager to get features out constantly, and have skipped routine auditing of contracts. That's not a good thing to look for. As much as at the end of the day, I understand that pressure of wanting to get things up to the market, with these interoperable cross-chain bridges, they're usually sometimes focused way too much on the marketing aspect, building partnerships, and they don't make sure to nail down their technology and to battle test it, right? The second thing here, again, deploying straight to mainnet. I have no comments on this outside of it's a purely negative behavior to just go ahead and deploy, especially if you're building a complex DeFi protocol. So just go ahead and deploy straight to mainnet without going through, especially, sometimes this isn't 100% necessary, but overall, you want to make sure you go through the auditing. That's the big gem here, the big star. You want to see clear auditing of the protocol. And not to mention, if it's a brand new project with low TVL, you might do both of these things here, right? You might nail these things and actually, do the positive signs up here so you don't skip auditing contracts and you don't deploy straight to mainnet. But if you are a brand new project with low TVL, it's not to say that you can't adopt or support it. But you shouldn't go all in this case, with all your money and all your trust to assume that the team has your better interest, that the project itself has been audited and has gone through extensive checks and balances and functions the way it's supposed to, that there's no chance of exploits. That's not smart. It's like putting all your money in a penny stock or some new startup venture. It's great to be able to invest and participate in that and support things, but you shouldn't go all into one thing. I would never advise for that, whether it be an investing thesis or in a participation thesis, no matter how much you love the idea. Plain and simple, guys. And this is something, again, I want to talk, because I know on the channel you guys come here a lot in the sense of just kind of figuring out what's my investment thesis for the market? How do I go about investing in crypto? And the thing I always drill here, and I sometimes have a really difficult time explaining to people, because people want quick returns, they want to make great multiples, they want to maximize their potential capital gains. A lot of people ask me, Nick, why are you invested in Uni token? Now that's the thing I get asked a lot. Why am I so bullish on Uni in this case? And why am I okay with, rising all the way up here to $44 and coming down to $14, $13 and rising back up to 30 and possibly climbing higher? Nick, why are you so okay with just investing in Uni when it's already one of the largest cryptos? Why are you okay with just investing in Ethereum? It's because I understand that they have a very, very nice risk to reward ratio. I'm not going to put 50% of my capital into a variety of different no-name DeFi projects. Now, you can put a lot of micro investments into a lot of high-risk projects. That's not an entirely bad investment thesis. What I'm saying, though, is that I wouldn't put it all in to 1, 2, or 3, or even 10 various DeFi protocols that are all small caps because of a couple different factors. One, I want to know in this case where money is going to flow. And in this cycle, institutions are generally going to be buying the established DeFi protocols. They're not investing in a lot of the niche DeFi protocols. Not to say that there can't be an investment thesis for it, right? If you capture something early on, yeah, you're generally going to have to invest in early on before the institutions. But the second thing as well is that I know fundamentally Uni has a good hold on a really exciting market, which is automated market making or decentralized exchanges. And as I know that it has a great hold on this potential multi-$100 billion, if not $1 trillion market of being a global automated market maker, an order book in this case, even though there's no order books on AMMs, this kind of globalized exchange for all types of assets, why bet against it, right? You don't even have to capture a 10 or 100x opportunity overnight to get rich. What you need to do is have multiple trading and investment opportunities where you capture these kind of multiples, lock in profits when things get too euphoric and excited, and make sure you nail those 2, 3, 5x bets. And you can compound over and over, time and time again, if you're able to be rational, lock in profits, and keep your vision on those longer term bets that are much more safe, but also provide great returns if you know what you're doing. All right. So anyways, guys, I've rambled on enough here today in regards to this, but I want to go ahead and actually dive into a project within the Polygon ecosystem on one of those layer 2 protocols that is not only doing something interesting, which is tied to a protocol I like in this case, which is Uniswap, and it's providing AMM services, but also outside of this as well has gone through the proper routine security audits, which we should expect from all various protocols. So let's go ahead and dive in to our sponsored review of a new Polygon AMM DinoSwap. Alrighty everyone, so in today's sponsored review, we're going to be taking a look over a new project within the Polygon ecosystem, and it is no other than DinoSwap. Now for those of you out there who are hearing about it for the first time, to put it simple, DinoSwap is not only aiming to expedite and increase the amount of assets from layer 1 protocols onto layer 2 within the Polygon ecosystem, but is aiming to serve as almost an aggregator or central AMM for liquidity in the Polygon ecosystem to not only provide deep liquidity, but also make sure that you can do so in an environment where everyone can trade on a low-cost basis and in a scalable way. And the thing is, I'll be completely candid with you guys, as we talked about some of the topics earlier on in today's video, I do want to mention that DinoSwap is relatively new, but it does a lot of things right in regards to the actual security audit practices that we discussed earlier, and outside of that, offers the ability to engage in a variety of layer 1 activities that are generally expensive to engage on layer 1, and also has some pretty interesting approaches to things that I haven't seen on other projects. I will say that I'm relatively new to the Polygon ecosystem, but again, I want to spend some time to talk about what I do understand about the protocol and why you guys might want to, again, check it out. Again, as we talked about earlier, this is one of many different projects out there that are emerging within the DeFi and layer 2 space. So first off, as you all know, I like automated market makers, and that's the core premise of what DinoSwap is offering, the ability to have a decentralized exchange that everyone can access on layer 2. They have over $300 million in TVL, or total value locked, in the protocol, which again is really good for an early stage product. But again, let's go ahead and actually focus on what you can do within the Dino ecosystem. So the first thing you have to do is, because the DinoSwap ecosystem is not on the layer 1 of Ethereum, if you haven't already, you're going to have to migrate assets from Ethereum over to Polygon. Now again, you can use the Dino token, you can use a variety of different bridges. They have a few different opportunities to move from, but you're able to bridge from Dino on Ethereum, in this case, to Dino and Polygon. And once you've moved to the Polygon ecosystem, you can now actually engage in exchanging. So we can go over here to the exchange product. And once you have your wallet connected, you're actually able to trade from one token to another. This is a very similar format to what you guys have probably seen through Uniswap or SushiSwap or PancakeSwap, where you're basically going from one singular asset to another. So if I wanted to, for example, trade from Matic tokens on layer 2 in the Polygon ecosystem to layer 2 Aave, I can go ahead and do that. Maybe I want to trade 10 tokens, in this case 10 Matic for 0.03 Aave. I can see my price impact, my liquidity provider fee, and the minimum amount I'll receive. And you can basically go ahead and actually engage in this. You can also engage in bridging as well. So if you still need to bridge assets, you can go through the proper bridging elements that you know probably commonly if you've used Polygon from a common wallet on the Ethereum network, right? So that's the core element here, is automated market making. It's similar in many ways to what you'd see with Uniswap and PancakeSwap, and again is why I have a lot of trust in the sense of the security and the functionality of DinoSwap, because at the end of the day, it's not rocket science to build AMMs. The really great value proposition here that the DinoSwap team is really doing is they're building this within the Polygon ecosystem to be able to provide that central place where you can trade a variety of different assets. So basically nailing down what Uniswap has done on layer 1, but in a layer 2 ecosystem, and aggregating as much liquidity as possible from different opportunities. Now, outside of this as well, they're also doing what PancakeSwap or what SushiSwap had really nailed down within their respective ecosystems, and that's the element in this case of taking LP tokens or liquidity provider tokens and farming them and getting some kind of yield. The problem with a lot of the previous farming protocols, and I'll be candid with you guys, I'm a relatively new person when it comes to farming. I don't engage in it too much. However, I will say that for those of you who are interested in farming or want to look into it, they have different types of ways that you can farm within the DinoSwap ecosystem. And they're focused on actually building it where the rewards in this case are going to be something that incentivizes you to participate in the Dino ecosystem as well as be able to eventually potentially burn Dino tokens for a variety of different ecosystem tokens within Polygon. So again, think of Dino in this case as kind of a settlement token within the ecosystem. It's a pretty simple way to think about it. So the first thing you can do here is you can start to take your LP tokens, which again, if you're a liquidity provider, your main revenue source is focusing on collecting fees from trading. But you can take your LP tokens and earn Dino by simply basically farming in this case, right? And it really doesn't cost you anything extra. You're just basically taking your LP tokens, which would generally be sitting there, and you're able to actually farm them for an APR of Dino tokens. You can see that there's different pairs here, and communities are able to help incentivize liquidity provision by providing these yields. Right? So that's the first step here, these fossil farms, which are next to the exchange. But you also have extinction pools. Now, extinction pools are where you can stake Dino to earn different types of rewards. So you can, for example, stake Dino and you'll get an ROI of 226%, at least at current yields. So you'll earn some Dino by staking. You can also do it with Quick Pool, which is one of the biggest AMMs on the Polygon ecosystem. XMark token or benchmark protocol, one of the protocols we work with. There's a variety of different ones that you can do here, and there will be new opportunities that happen over time. The Jurassic pools, in this case, allow you to, in this case, stake your tokens, but not implement a burn on your tokens. You just earn. So you unstake at any time, right? Now, again, as we go back here to the extinction pools, an important thing to understand is that when you're entering these pools and you're putting in Dino to get some kind of yield, you understand and agree that 100% of your Dino is going to be burnt in this case. So it's going out of the circulating supply. Again, acting as a settlement token to get access to different types of opportunities, right? And there will be other ones that come up over time. Now, if there are any questions that you guys have in regards to understanding how these different elements or opportunities work within the DinoSwap ecosystem, you can always check out. DinoSwap actually has some really great documentation on their website. This is the docs section. So if you go to DinoSwap and you come here, we'll go back to the protocol. If you click on this link right here, you'll be able to access all the different types of documentation around both the Dino tokenomics, if you guys are interested to look into that, or learning about the actual protocol itself and how to actually engage in it and get some kind of yield. Again, for me though, to be completely candid with you guys, being new to the Polygon ecosystem as a whole is something that, again, I always recommend people go through, follow proper tutorials on how to engage in Polygon, learning best practices before you engage with something like DinoSwap, just to know how to actually engage within the Polygon ecosystem. And outside of that as well, understand that Polygon, even though it's come a very, very long way, it has a ton of different protocols that we respect here on the channel, like Aave, Curve Finance, Polymarket, QuickSwap, 1inch, EasyFi, a whole different range of things, SushiSwap. You can go down the list. They've got a ton of different protocols within the Polygon ecosystem. One thing that I always think is important to mention, because Polygon is still in its early days, is the fact that it still has to work towards further decentralizing the overall management of assets in the Layer 2 ecosystem. That's one thing I'd like to see. It's not something against DinoSwap. It's purely on the Polygon side, just being completely candid out front with you guys. But outside of this, there's a lot of major projects, and again, it speaks to the volume about how far Polygon has come as a kind of scaling solution within the Ethereum ecosystem. So again, make sure to do some research on it, guys. You guys can take a look into it. One of the things that I did want to share, because I think it goes exactly in line with what we talked about today, is following standard security practices. And in this case, DinoSwap was fully audited by CertiK for a third consecutive time. Now, I will say I would love to see, and this is just my personal candid thoughts, I'd love to see the DinoSwap team potentially pursue, as time progresses, whether they add new functionality or they just want to bolster security, to go through some audits from a variety of different auditing firms. It's just that resources are relatively tight right now. But to go through a third routine audit through CertiK is really, really nice here. And CertiK is one of the larger auditing firms within the crypto space. So again, I want to give major props to the team for pursuing this and following best practice, not trying to immediately rush into the Polygon ecosystem, but actually doing things right and making sure to service AMM functionality at its core for the users in the Polygon ecosystem, but also these different opportunities as the farming elements of DinoSwap offer, in the sense of providing opportunities to get yield in a variety of different projects that you may like, in this case within Polygon, right? So again, you guys are welcome to take a look into it. I'd love to get your thoughts on it candidly if you guys are interested in DinoSwap. Again, as we talked about earlier, best practices. Just test around these protocols, right? You don't have to fall in love with any specific project. but make sure you take a good candid overview of what Dynaswap has to offer. And at the end of the day, you might just be like me, where you might want to use the AMM functionality and not have to pay the atrocious gas fees that you can incur on layer 1 24/7, only when you have to actually settle back to layer 1. That could be what your focus is. And in that case, Dynaswap offers it, just like you can expect with Uniswap. But it reaches a wide range of layer 2 liquidity that if you're trading with a couple $100, a couple $1,000, you're going to get a much better offer in this case than what you get routinely on layer 1 considering gas fees. So anyways, guys, that's it for today's video. If you guys want to check out Dynaswap, I'll leave a link down below in the description. But I hope you guys enjoyed this video. It's important to make sure that we follow good practices within the cryptocurrency space. And I think that there are a lot of projects out there doing good. It's unfortunate because there are some of these events that can leave such a bad taste in the broader DeFi and crypto ecosystem. But there are a lot of innovators and people doing things the right way. And if you can follow those steps, you can end up on the right side of history. So guys, thank you all so much for watching, and I'll see you all in the next video. Take care, everyone.